Welcome to ForexTV.com. Today is Tuesday, April 28th. I'm Tim Kelly with the New York Forex Market Buzz. Euro has turned modestly higher, erasing recent losses against other major rivals. Now for a look at the latest headlines. U.S. Conference Board's Consumer Confidence Index surprised to the upside this month, marking its largest jump since November of 2005. The index rose to a reading of 39.2 from March's upwardly revised 26.9 level. Economists had expected the survey to rise 29 to 29.9 this month. Elsewhere, the S&P Case-Shiller Home Price Index fell to a reading of 143.17 in February against expectations for a decline to 142.80. January's figure was revised down to 146.35 from an initial reading of 146.40. And manufacturing activity in the U.S. mid-Atlantic states continued to improve this month, according to a report from the Richmond Federal Reserve. The headline manufacturing index surged to a reading of -9 this month, beating expectations for a -17 reading. The index stood at -20 in March and -51 in February. Today we're joined by Brian Dolan, Chief Currency Strategist at Gain Capital. Brian, welcome to the program.
Hi, good afternoon, Tim.
Brian, we saw a little bit of a seesaw or a tennis match, I think you called it, in yesterday's activity in risk appetite, where there was a little bit of risk aversion. I think that followed reports of swine flu. We saw risk trades sell off in the overnight in Asia, only to come back this morning. Why don't you give us a little bit of a window into the market sentiment at this point? It seems to be driving prices at this stage.
Sure. Over the weekend, the swine flu news dominated, and that's what carried on into early trading on Monday. And so, for that reason, the initial reports were quite alarming, with it spreading into various other countries and new cases being discovered. So, as the day wore on, so the risk appetites began to fade at that point. Looking at the declines in basically the tourism and transportation industry, and that carried on. Very quickly, though, that fear seemed to subside, basically with a recognition that this is a treatable virus at the moment in its current form, and it's unlikely to significantly impact overall tourism outside of Mexico for any length of time. So it's a minor shock to the system, but it seems to be relatively quickly shrugged off. And then in the shorter term today, some of the data coming out, certainly in the U.S., beating expectations, and then overnight as well, some improvements in further European confidence indicators, also basically limiting the downside for basically the risk aversion. And then today has been spent, and we've been through this now numerous times in recent weeks, that the down move or say the surge in risk aversion is being offset then by some stabilizing data, and so stocks and the riskier assets come back. So today, in addition, we've had a number of some comments from the ECB's Beanie Smaghi, suggesting that the quantitative easing policy debate has not yet reached a conclusion, and he seemed to cast doubt. He certainly depicted himself as voting against quantitative easing. And so this comes on the heels of the Austrian central bank leader Novotny yesterday suggesting that quantitative easing was going to be adopted in some form, and that was partly behind the euro's weakness yesterday. So we're getting the kind of constant back and forth in terms of both policy, data, and then fundamental developments worldwide, keeping us going. So sentiment right now, I think, is still extraordinarily divided, and if you were to put them on either side of a scale, I think your optimists and your pessimists would weigh equally the same. It's really that much of a short-term market, and the short-term data is encouraging, but the longer-term picture is still very bleak, and so that keeps the sentiment still highly divided.
Okay, Brian, how do you think that gold and commodities are tipping that scale either way today?
I think there's a bit of a recognition, certainly in the commodity space, that we are in for a longer haul, and so the recent rally that we did have in commodity prices has likely stalled, And then gold on its own yesterday, it ran into some significant technical resistance, and it looked to be a more significant position unloading for today's sell-off in gold prices. Keep in mind we are approaching month end, and we do tend to see a bit of position reduction going into month end.
Okay, Brian, I want to get back to ECB. You set that up nicely. Why don't we start there in terms of specific currencies? We're looking at an ECB meeting on the 7th of May. We should, some feel that the speculation over quantitative easing should end at that May 7th meeting and the statements following that meeting. What's your take there either way? If we get some type of quantitative easing message from the ECB, does that end speculation about the euro? Does that push us higher? Excuse me. And if we don't get that quantitative easing issue cleared up, does that weigh on euro?
I would say yes. If they do announce quantitative easing, some measures, then you're likely to see the euro decline. We got a taste of that yesterday with Novotny's comments, as I mentioned earlier. But every currency that has the initial response to every currency that whose central bank has undertaken quantitative easing has been for that currency to weaken in the short term. And now the opposite holds true if they choose not to. And the comments today from Bini Smaghi seem to suggest that they may not be able to reach a consensus. There might very well be a significant number that favor quantitative easing, but if they're not able to reach a consensus, no deal is done, and the quantitative easing won't happen. That will remove a euro negative, and we're very likely to see. I think there's probably more upside for the euro with no quantitative easing and a relatively minimal rate cut down to 1%.
Okay, Brian, I want to shift gears here. We've got some data coming out tomorrow from central banks, Fed, RB&Z, and to a lesser extent BOJ. Maybe we'll focus on Kiwi right now. Widely expected there'll be a half a percentage, 50 basis point cut, but there is speculation also that it could be less than that. There's been a lot of cuts. They do have some room there. What's your sense of that situation tomorrow?
Right. We're coming down on the side that they're only likely to do 25 basis points. All the comments from RB&Z Governor Ballard after recent meetings have been that future rate cuts will be much smaller than the 75 and 100 plus basis point rate cuts they've taken in the past. And there is, with the sense of some stabilization emerging, we think that they're likely to cut less than expected. And that ultimately this would lead to a little bit of at least short-term strength in the New Zealand dollar.
Where do you see Kiwi going if we do get that 25 basis point cut? We're at 55.84 right now. Traded in a range of 55.26, 56.54, relatively tight range at this point. What are your expectations either way? If we do get that surprise for a less than expected cut at 25 basis points, do we push do we push over to 60 in Kiwi?
I'm not that aggressive on it, but I think certainly you can see back to the recent highs around 50, basically 58, 59 in the New Zealand dollar. It would be a further indication that the RB&Z is concluding its cycle of interest rate cuts and likely lead to more gains ahead. But just for the short term, initial targets are in the 58 to 59 area. Looking a little bit further out, the slower, unfortunately with the swine flu, one of the odd casualties is likely to be New Zealand, more so than others. And part of that is not just that a few cases have been detected there, but that the New Zealand economy is heavily reliant on tourism, and given its small size, that's likely to be a bigger negative in the near future. So I think the 60 area should still continue to contain the New Zealand dollar on the upside. I am mindful of the 200-day moving average, which is currently about 59 and a quarter. And if we do get above there, then it does raise the prospect of for further gains above 60 cents back towards 62 and a half to 63. But I think the central bank rate decisions have been they're becoming somewhat of an anticlimactic occurrence these days. and then it's just back to dealing with the global recession and how long does this thing play out.
Okay, Brian, I want to stay in the region there. You see a risk trade coming back today, but I guess you'd say one of the underperformers today is Aussie U.S. dollar. Slipped under that 70 level. The 70 handle was breached last night again. Second time in 2 weeks. We hit 69.50, rebounded up to about the 72 level last week. But what do you think? It looks like it's trading a bit heavy right now and has not been a benefactor of this return to risk today.
That's correct, and I think the main association there is going to be with gold prices and the fact that they're significantly lower and basically suffered a major rejection in terms of their attempts to recover and basically try to make another run at above $1,000. So that effort or that attempt was snuffed out pretty quickly, and I think Aussie's feeling some of the heat from that.
Okay, and to finish up in the neighborhood there, dollar yen. Half of the analysts I talked to, Brian, were expecting to see $105 yen by this time or perhaps the middle of the next month, and it looks like that's trading heavy as well. Dollar seems to struggle at parity. Any sense of what might be happening there, considering this is a test of wills almost at parity.
Right. I was one of those analysts looking for 105. My initial target was nearly achieved at 102, but ultimately what happened is we ran into a bit of a stall up there, and I think one of the main drivers again that's leading to this yen strength is a further deleveraging, disinvestment by Japanese asset managers, basically bringing yen home. And what we can see is that, in terms of risk sentiment, FX sentiment, risk sentiment improved and peaked basically in early April, and that's very coincident with dollar yen's topping out. And then since then, we have had a nice pullback. It's important to note on the pullback, we got to we tested actually inside of the Ichimoku cloud in dollar yen. That was down at the top of the cloud is down at 95.95, and we made a low around about just above 95.50. So the recovery then in dollar yen today suggests that we may be looking at the end of the pullback in dollar yen and the end of the yen strength, which is potentially a bullish sign for how stocks are heading. But I'm going to wait to see how we open up the new month and basically where we are at the beginning of next week before I really latch on any firmer belief in that view. In the meantime, I think what the overall risky currencies are suggesting for us is that we are going to be dealing with this global recession for a while, and that sentiment has likely gotten as high as it's going to get in the near term, and that as we digest the further realities of how this recession plays out, that we're going to see a return to risk aversion, and we're going to start to see the yen strengthen a bit further, and we'll just need to keep an eye on where we are relative to the cloud. The break above the cloud was pretty significant way back in the beginning of February. The middle of February, and that really did shift the overall risk appetites for the market, I think.
Well, we're testing the top of the cloud right now, the upper band of the cloud presently. If we do go into the cloud on a daily basis, does that change your bias?
Yeah, that would definitely be significant. I think then we'd be looking at either some extremely negative U.S. dollar news behind that, or a much more alarming downturn in the data leading to sharper weakness in the yen crosses. Again, the buying the yen for any kind of a benefit out of Japan or betting on Japan is completely, I think, misguided. They are, in terms of the major, as far as this global downturn goes, I think they're going to be one of the worst hurt, and they're likely to see the lamest and most subdued recovery of all the major economies. So The yen is not to be bought, based on its own merits. Really simply as the dynamic of risk appetites, risk aversion, or versus risk seeking.
Brian, I think we'll leave it there. Thank you very much for your insights today. Appreciate you joining us.
All right, Tim. Thank you. My pleasure.
This has been your New York Forex Market Buzz with Brian Dolan of Forex.com. I'm Tim Kelly. Join us later this afternoon for PM Exchange right here on ForexTV.com.